1987, the SEC issued a letter to all the exchanges to come up with a product that would offset this quote unquote portfolio trading that they blamed for the crash. So all the exchanges took up the mantle, but the Amex took it up the most. And that's when we see the launch in 1993 of the Spiders, the first ETF.
Well, explain that a little bit. So why did they blame sort of the portfolio trading for the crash?
Because of the nature of the futures, they could sell futures and buy baskets, and conversely sell the baskets, which are all the stocks, and buy the futures, right? And it just kind of fed on itself, as well as the market wanted to go down. It was like one of those things where you can't just argue with it. It was starting to slip slide away to begin with, and that just kind of, they had to blame somebody, right? Let's face back. So, but they did add to it. And they wanted to, come back with a product that could offset that. Is there a product we can create that'll offset some of that portfolio trading, so to speak? And that was kind of their mission in life, to do that.
So what you're saying then is that the actual futures market allowed for this cash and carry trade, where you can, if there was, like the futures price was higher, then they would buy the stock and then sell the future, or the reverse.
Which is fine. It's the other way around that hit it, because they sold the baskets. So they were selling all the stocks, right? And buying the futures. And that's where they got hurt.
So that was the other way around. And basically traders were doing this because I guess the futures were lower than the current price, something like that?
Yeah, it was complete chaos, Jimmy. It was complete chaos. Everything was out of whack. Everything was out of line. So anytime there was an arbitrage, that would just kick into place. There was so many different cross currents and things going on that particular day. And it was, like I said, the first time the futures really took center stage for a lot of people. You got to remember, most of these people came from an equity background. And now you have an option future market that's just kind of running rampant. They didn't know how to handle it. It was just a lot of stuff going on in a very short period of time. So that's why the SEC came out, issued this kind of letter to everybody. That was the genesis of getting the ETFs up and running.
Okay, so can you explain that part a little bit? How something like an ETF, I guess, prevent the selling of the current and buying the future, like that arbitrage trade? How does that prevent that or mitigate it in some way?
The real key to the ETFs, that the ET means something, exchange traded, and the ability to create and redeem is the only product that I'm aware of in the world. You can do that. So if you want to get out of a product, whether a future product or any stock product, you have to sell it, correct? Or you're short, you have to buy it back. In ETFs, you can create. So if you're a short and you've been selling this particular instrument for X amount of time, you can turn around and do a creation unit and get it all back. That completely changes the mindset. Conversely, if you're getting everyone's selling everything to you and you're on the market making side, you now have the ability to redeem these. And that in and of itself changes the game dramatically.
Okay, well, so that was sort of like the impetus, was the 87 crash, where options and futures and other derivatives, I guess, kind of took center stage. So you're part of Amex and you're seeing this thing take off. What was it like when the first ETF, I believe it was Spiders with Amex, right? Like,
yeah,
what was that
SPY,
like?
Spiders, yeah.
What was that like?
It was quiet, actually, Jimmy. It took a little while, for everybody to kind of realize what they were, how to use them. At that time, Jimmy, there was a thing called you had to have an uptick to short something, right? So you had any stock you wanted to short, you needed an uptick to short it. Well, Spiders was the first instrument you didn't need an uptick; you could short it. And I explained that to brokers about 9,000 times. Yeah, you sure you can? Yes, you can short it. Because I mean, for your whole life, you're just doing an uptick. That kind of opens up once again some fluidity to the market and liquidity that you normally wouldn't get. It took about 2 years, Jimmy, about 95, 96. That has started to really kind of take off. People started to figure out how to use them. A lot of guys would come in and just do, big funds would come in and buy like 1 million shares on the morning, do what they had to do throughout the day and come back at the end of the day and close them out. Almost like it was just parking them there. And then more and more people started to understand that these are pretty liquid. They traded what's called UTP. So they traded everywhere. They traded in Chicago. They traded all the regionals as well. The primary market obviously was the Amex. So it was traded all across the country. They just kind of bit by bit, people started to write about them. People started to understand them a little bit better. A lot of the closed-end community were the first writers of these because they were the closest to a closed-end fund as you can imagine at the time. They weren't anything. They were different animal totally, but those are the only people writing about them. And then it just kind of just slowly, the big houses figured it out how to use them, and Merrill Lynch had figured out how to use them, and started seeing a lot of research reports come out. And then it just kind of took off, and more products came out. Now, initially, we just saw the index products. We saw SPY, we saw the diamonds, which is the Dow Jones product. We saw MDY, the mid cap product. So we saw it was very, very index centric initially. And we saw the advent of iShares come out in 2000, and they started to come out with some different type products, Jimmy. They started to come out with emerging market products. They started coming out with China products, FCI, and they were kind of a little bit ahead of themselves. But when the market caught up to them, they were the only game in town waiting for them. So India, we saw a lot of the emerging markets, and as well as we saw some frontier markets. There was some interesting thing going on. So it expanded out from just the index aspect to other areas within the market. Soon we saw, then eventually ventured into the fixed income market. So that was another big watershed mark when it went into fixed income ETFs. I think you can go back to last year when the Fed started to buy all those fixed income ETFs as part of their kind of shoring up the balance sheet. That kind of really affirmed once and for all that this is the real deal when they went in and did that. So that's kind of the broad. And now we have thematic ETFs, and we have VIX ETFs. And now we're into the Bitcoin futures ETFs, which was it was just a natural process. If the wrapper is agnostic and it can hold just about anything in it. So this is pretty exciting to all of us here.
Well, so let's go back to sort of the first ETF, the Spiders ETF. Was that a spot or futures based ETF at the very beginning?
It was basket. It was based on a basket of 500 stocks.
So it was spot, like